Yes, sir.
So, if you look at the top band, so there are equity. So we have covered the equity mutual funds. So the project which has been given to you is to basically analyze the equity and debt funds. And maybe that you can cover even the hybrid also, okay, which is the mix of debt and debt and equity. So, so it will just focus on the debt more, and maybe that will cover some of the hybrid funds also. So if you can see on your screen, there are a lot of funds, okay? So, Mahalakshmi, can you just read, how many funds are there? I mean, first of all, how many subcategories of debt funds are there?
So there's low duration, long duration, corporate bonds, and fixed maturity plans, and so many. And do I read everything?
Yeah, no, it's okay. No, there are a lot of funds, okay, fine. So these are lot of categories. Like, you can see, one of the word is very common, duration, okay, low duration, short duration, medium duration, long duration, medium to long duration, okay. So there are about, I think, ultra short duration. Okay. So there are so many kinds of funds. Okay. So what I did was that, uh, I just went to ChatGPT. So I asked, to explain these funds. Okay. So, Mahalakshmi, can you read that category, debt funds?
Debt mutual funds invest primarily in fixed income securities like bonds, treasury bills, and other debt instruments. Within this category, there are multiple subtypes based on the maturity period and risk
Okay,
profile.
hold on. So, they invest in fixed income securities. Now, but that means they're going to invest the money into bonds where, we will have fixed income. Okay. Treasury bills, the bonds, treasury bills, the treasury bills are issued by the government. Okay. Bonds can be issued by either the government or by the corporate world. Okay. And other debt instruments. So we'll talk of them. So within this category, there are multiple subtypes. So one of them is called, just read this, Mahalakshmi.
Low duration fund. They are select bonds or debt instruments such that the average maturity period of the portfolio is between 6 to 12 months. And the key characteristics of this are these funds have shorter duration, making them less sensitive to interest rate fluctuations. They are expected to offer moderate returns, higher than liquid funds, but lower than long term debt funds. And they provide a balance between liquidity and yield. So it's suitable for investors with an investment horizon of 1 to 3 years who are looking for an alternative to bank fixed deposits with potentially better returns and moderate risk.
Okay. Now, the one of the key thing is that they are basically alternate to fixed deposits. So many of us traditionally, our parents, our grandparents, they have been putting money in fixed deposits, okay, which are considered to be very safe and give a lower return than the equity. But that has been one of the, and if you have a short-term horizon, then fixed deposit works well with you, okay, and they're, I mean, not risky at all. So there is another, this is called low duration fund, which is actually competing with the fixed deposits. Okay. Now, if you look at, a fixed deposit funds, now how much return they give is basically, I have shared in my slide. Okay. I'll just open that. And then we compare it, how much we get, here. Okay. So can you see the fixed deposits on your slides, this thing on your screen? So these are the rates which are there on 11th of October 2025, because the interest rates keeps changing. Okay. So like, the Bandhan Bank is giving, 7.2 kind of, rate of interest, and 7.95 is for the senior citizens. Of course, they're appearing twice, so just ignore the other one. So 7.2 is coming twice, as well as 7.95 is coming twice. So 7.2 is basically given by Bandhan Bank. If you open a fixed deposit, that means if you go to the bank and say that I want to put my money for a year or 6 months or whatever, so they are going to give you 7.2% return. And if you are a senior citizen above 80, above 60, then the return is about 7.95%. So, so which bank, gives the highest in terms of the fixed deposit from the screen? Can you tell me which bank is giving the highest fixed deposit?
Utkarsh Small Finance
Utkarsh.
Bank.
So, and it's a small, bank which, hardly any people might have heard. So the smaller banks, because they have to compete, so they generally offer a little higher return. Now, which is the bank which is offering the lowest fixed deposit rate? State
SBI.
Bank India is the main bank. Okay, now if you find that the State Bank is one of the main banks which is appearing in this list, and of course there will be HDFC Bank, ICICI Bank, so they will be giving a return very close to about 6.5 to 7%. So the range is around 6.5 to 7.5% is the return which is given by fixed deposit. Then we'll compare how these funds give the low duration, okay, and see whether they're really competing with this. So we'll do that little later. So let's understand a little bit more about low duration. So low duration funds, they invest with a Macaulay duration close to about 6 to 12 months. Okay, so since they have a low Macaulay duration, so these funds have shorter duration, making them less sensitive to interest rate fluctuations. Now, if the interest rate change, then we'll get these funds also will also their values will change. Okay, as we know, there is an inverse relationship, and today we are going to understand that relationship through an Excel sheet. So if the interest rate goes up, the bond values fall, and vice versa. If the interest rate falls, the bond value goes up. Okay. So, these funds can, they're slightly less volatile because they're less sensitive to interest rates. Of course, if you find the interest rates are coming down, these bonds, low duration bonds will give you little higher return. Okay. Which means the bond values will go up, the NAV will go up. And if the person has selected these funds and at the time and thereafter the interest rate starts coming down, then these bonds give you a slightly higher return, okay, compared to the coupon which they have actually published. So expect to offer moderate returns, higher than liquid funds. Of course, because liquid funds have very low duration, I mean, almost like zero duration, so they are not at all sensitive to the interest rates. So, so these low duration funds will definitely offer a higher, return in case if the interest rate goes down. But if the interest rates comes down, then these funds give a very poor result, and even less than the liquid funds. Okay. So these are selected. These are for the investors who have an horizon of 1 to 3 years. Okay. So let's go to this and just choose the low duration fund. Okay. And then uh, so these are all low duration funds, and look at a 1 year return. Fine. So 1 year return is, now it is coming in order of this thing. So how much return you are getting in 1 year's time? Mahalakshmi, what is a kind of return, approximately a range, which is available on your screen? Okay. Fine. So I'm just going to, yeah. So now it is from the top to the bottom. Okay. So, the first one is giving 9.36. So this is an outlier. Okay. Right. So HDFC low duration fund is giving 9.36. But all other funds are basically in a range of about 8%. Okay, fine. For example, the Kotak low duration fund. How much Kotak low duration fund is giving? In
8.17.
8.17. And in 2 years frame, it is giving 8.12. Okay. So within 1 or 2 years, it has given about a return about 8.1 to 8.12. So now, if you look at, a kind of a return, as a monthly return, like in the last 1 month, it has given 0.68. Okay. So if you analyze it, it'll be about, like 0.68 into 12. So, so then it will be 6.8 and then another 1.6. So it will be almost like 7.5 to 8%. Okay. So how much money has been invested in this fund? 14,000 crores. Okay. That's you can see here. Almost this fund, is having 14,000 crores in its, people have invested. It's a two-star rated fund. And I have put a lot of money of a long back, about 50 lakh rupees I have invested in this fund. But now I think I have reduced a bit. Okay. Now, in terms of AUM, so which is the biggest fund? I mean, which is the fund where maximum people have invested? Ranjana, are you there? Mahalakshmi? Yeah.
Yes, sir.
So which is the biggest fund, a scheme where people have invested in a low duration fund? Look at the AUM, the corpus of the fund, where
Yeah, so it's
yeah,
ICICI.
ICICI Prudential Saving Fund. Okay, so where 27,000 crore rupees have been put into this fund, and this fund has been giving almost like 7.96%, slightly little less compared to the 8.17 which we saw earlier, and it's a three-star fund. Okay, fine. Now there's something called YTM. Can you see that? YTM. So what is the YTM of ICICI Prudential Fund? 6.8%. Okay. And let's see the YTM of the top fund, which is, LIC, is 7.43, 6.94. So YTM stands for yield to maturity. Okay. I'm going to explain this. This is a very important concept. So if you hold this fund, uh, you know, till maturity, that means the funds which this scheme has been invested. If you if you remain invested till they hold these bonds, then you're going to get this much of return. Okay, fine. So let me just take you to the Excel sheet where we can explain that concept. So this is very important. So please focus. Okay. So bond. Okay. Can you see an Excel sheet on your screen? Shrishti, can you see that Excel sheet?
Yes, sir.
Okay. No, please now focus here. The very important concept which I'm going to explain. Suppose there is a bond, okay, which is a corporate bond or it can be a government bond, which has a coupon of 7%. That means if you buy this bond at say 100 rupees, minus 100 means that you're going to invest 100 rupees, so that will go out of your pocket. Okay. And this bond is for how many years? 1, 2, 3, 4, 5, 6, 7. So I think I've written on the top now. So this bond goes from 2023 till 2032. Okay. So this is 10, yeah, it is 10 here. So it's a 10-year bond. Okay. A 10-year bond. Look at the top. So each year, if you buy this bond, you're going to get 7% rate of return. So invest 100 rupees, you're going to get 7 in the first year, second year 7, third year 7, and like this, and you will keep it. In the 10th year, you're going to get 107 rupees back. Okay, fine. So now we all know that you will, because the coupon rate is 7%. So the return or yield to maturity, that means if you hold this bond till maturity, you are going to get 7% return. Now, of course, there's a formula to calculate that, but in this case, it's quite evident. So you don't have to, even calculate it. But if you have to calculate how much return I'm getting, so you go to IRR. Okay, fine. And then select all the values right from the beginning till the end. Okay. And then say press OK. So it will give you a return here. So that means, this means that if you hold this bond for 10 years, then your YTM is 7%. Have you got it? Shrishti, Mahalakshmi, Ranjana, Ishani, others?
Yes,
Okay.
sir.
Yes, sir. But
Yeah.
can you explain the raw formula also that is used here?
This is the formula. If you look at the formula is IRR. Okay, fine. So what I'm doing is that I'm just again trying to know, this has been calculated here. I just want to know, if I want to know what is the YTM. Suppose it will be slightly difficult, which I'm going to explain after some time in my coming part of my slide. So suppose you want to know what is the return. If you hold this bond till maturity, what is the YTM? So just go to the formula and select IRR. Okay, and then put your cursor at the beginning, which means how much you're going to invest, how much you're going to get every year, and at the end you're going to get how much? 107. That means your principal plus your interest in the final year. So you had put $100, which you are going to get 100 rupees in the 10th year along with your coupon. Okay. So if you put these values here, then press OK. So you will get a number. It is called YTM. Is it clear now? The formula, please. Who asked this question, Shrishti?
Yes, sir, it's
Okay.
clear.
So now if you want to calculate YTM of any bond, you can do it. Okay. Now it was very simple and very intuitive to know the YTM here, because we're talking about the very simple example. Now think that you are in 2025. Now here the bond was issued which year? 2023. So couple of years have passed. Now what has happened is the current market rate of interest has come down to 6%. That means the same very bond which was issued by the company is going to be offered at 6% coupon rate, because the interest rates have come down. So these bonds are already there, so they will carry 7%. So anybody who has bought these bonds, he is going to keep continue 7% for the remaining part, which is the remaining 8 years. So 2023 the bond was issued, and now we are in 2025. Suppose now the rate of interest has come down to 6%. Okay. So now you have two choices. One, to go in the primary market. That means, this company, suppose, issues fresh bonds. So you can buy those bonds at a coupon rate of 6%. So you get 666 and 106 at the end of the year of maturity. Now, the other option is that go to the stock exchange and buy this very bond, which will be trading in the market. Now, these bonds can be marketable. Many companies or governments, they'll get them listed on the stock exchange. Okay. So that means, anybody who has bought it can sell and exit, before the maturity. Or if, that means if you are selling, then somebody is going to buy it from you. Now, if somebody buys, he is going to get 7% return, isn't it? Because he's going to get 7 rupees. So, and suppose if you want to sell, you would not sell at $100. You are going to charge him a little bit more. Okay. So that, what will happen would be the market price of these bonds will go up because the interest rates have come down. Okay. So anybody who buys these bonds now, these bonds will be available at a premium in the market compared to a 6% bond, which is being selling in the market at $100. So a 7% bond, which has been already trading in the market, will be selling at a certain higher price, so that it gives you almost exactly the same return which is a new bond will give you, which is a 6% return. Okay. So let me just put my cursor here to show the formula here. Okay. The formula is that we are going to calculate the NPV now here, net present value. Okay. So what I'm doing is I'm trying to calculate the value of the bond now. Okay. At what price this bond will be trading in the market. Okay. So now the coupon rate is what? 6%. The new fresh coupon, which will be issued by the company, will be 6%. And now I'm going to choose, this from 7. I will not choose this 100. I'll choose this 7, 7, 7 and 100. Okay. So, sorry. So what I'll do first, I'll take 6% and then values I'll go to values and then put it like this and enter. So I'll just do it here. Okay. Then I go to, recently used, go to NPV. Okay. And choose the rate. Okay. And choose the values. So values will be that you're going to get 7 rupees, 7 rupees, 7 rupees and 107. Okay. Fine. So choose this and calculate the net present value of all. What we are trying to do is that we are trying to calculate the present value of all the money which you are going to receive. Okay. So that means this bond will be available in the market at 107.36. Now, what is the logic? What you are doing is that you are taking, all the money which you are going to receive if you have invested in this bond, which is, 7 rupees, 7 rupees, 7 rupees. And in the end, you're going to get 107. So what you're doing is that you're getting the present value of all this series of cash flows after discounting them at 6%. That means your yield should come 6%. That means your return should come 6%. So it will throw a value to you. That means the value of the corporate bond will go up to 107.36. So since the interest rates have come down, a 7% coupon bond, which was issued earlier, will now be selling in the market at 107.36, whereby it gives you a 6% return. So now you either buy it from the company directly or buy it from the stock exchange. So you're going to get 6% return. Okay. Now, so have you got it now? I mean, Shishti and others.
Yes, sir.
Now, suppose this bond is available at, suppose the bond value is available, say, cheaper. Okay, fine. Then suppose it is available at, say, 105. So you're going to buy it because it is cheaper, because the real value of the bond is 107. Okay. Now let's just take the second one. Okay, and then I'll explain that. Okay. Okay. Now, if suppose assume the rate of interest has gone up to 8%. Okay. Now, the fresh bond which has been issued by the company, or the company which is going to issue the fresh bonds, because the rate of interest have gone up now. Instead of going down, it has gone up. It has gone up to 8%. Now, the old bonds which are carrying 7% coupon rate will be selling at a discount in the market. Because if you sell to someone your bond, which you bought it is going to give him only 7% return, isn't it? So why he is going to buy from you unless you give him a discount? So you give him a discount and sell the bond at 93.2939, so which will actually give him a 8% return. How? I'm just going to use this formula again. So I choose the NPV. That means I'm going to choose now 8% return. That means if you want to get 8% return, what would be the price of this bond? So select everything, okay, and okay it. So that means you want an 8% return, which is this. So what should be the value of the bond? So this is the money what you're going to discount all these cash flows at a 8% interest rate. So the value of the bond will come to 93.29. So the real value of the bond in the market, if you want to sell, is 93.29. Suppose you are desperate, okay? You need money. Though you have bought a bond and you want to go and if you go to the market, you will not get $100 because now the fresh bonds which are issued by the company are giving 8% return, which means this bond will be selling at a discount compared to its original value, which is 100. Is that okay? Shrishti, Mahalakshmi,
Yes, sir.
Ananya?
Mhm.
Okay. So this which means as I told you that if the interest rate goes down, the bond values goes up. If the interest rate goes up, the bond values goes down. Okay, here the interest rates have gone down, bond value have gone up. Here the interest rates have gone up, the bond value has gone down. So there is an inverse relationship between the interest rate and the bond. Now, if you think, suppose if you are having a bond, okay, if you think that the interest rates are going to go down in future, suppose you do, now suppose think that you have to invest your money now in bonds. Now, what is the best time to invest in bonds? If you think the rate of interest will go down, buy bonds because it will give you a capital appreciation also along with the coupon. But now there's a catch here. The catch is that suppose if the value goes down, if the rate of interest goes up instead of going down, so your value will become less. No, you should not be worried about it. If you don't need money, just hold the bond till maturity and you're going to get 7% return. No, because since you have invested in a 7% return, you are going to get, all your coupons and 107. So that means your return will be, YTM will be only 7%. If you want to hold the bond till maturity, there is no loss to you or no gain to you. But if you want to make a short-term gain or a short-term, money, okay, in that case, it's a right time to buy the bond when the interest rates are going to go down. Okay, if suppose RBI they announce their credit me, I mean this thing, every month or couple of months they come and give a commentary regarding how would be what is the trajectory of interest rates or how the inflation is behaving in the country. So because when each time when they come and either raise the repo rate or decrease the repo rate, so they gave a commentary. So based on the commentary of RBI, so what RBI is expecting. Are they expecting the interest rates to go down and they are going to lower the repo rate? So if that is the case, then that is the right time to buy bonds because it will give you a capital appreciation. But this capital appreciation will be only till the extent the interest rates come down and within the maturity of the bond. But if you hold the bond till maturity, then this, extra money which you're going to make, you're not going to make that money. Okay. And neither you're going to even lose this money. Is that okay? So what is the right time to buy the bond? When the interest rates are going up or going down? Anyone, please?
Going
Yeah, if they
down.
go down, then you make money. Now, if suppose the rate of interest goes up, you are sitting on a loss. So, what you will do? You will hold the bond till maturity so that you don't suffer loss, or you sell the bond in the market because the bond value has come down. Now, I just repeat this question again. Okay. I say that the interest rates have gone up in the market. The bond which you had purchased at 7% is giving you this series of cash flows. Okay. But what happens is the interest rates have gone up now in the market. So the same bond which was available at 7% coupon rate is now available at 8% coupon rate. Okay. Now old bond will carry only 7%. So what will happen? The value of the bond will go down to 93.29. Now, if you're holding this bond, will you sell this bond even if you don't need money, or you will wait till maturity?
So waiting till maturity would be better if like instant cash is not needed.
If you don't need cash, then you hold till maturity. What will happen till maturity? You will get your 7% return and you will get 100 rupees back from the government rather than, in cashing at 93.29 today. Is that okay? Okay. Now, just check it. So, like suppose I said this bond, suppose is, selling today in the market, which was at 107. So what I did was that I made it say 103 rupees. Okay. Suppose in the market it is selling at 103 rupees, despite the interest rates going down. Okay. It is selling at this thing. So, and then I just make a formula change here. Okay. Now, what happened was, what I wanted to say explain was the rate of interest has come down to 6%. Okay. So now you have two choices, either to buy a bond from the primary market, go to the company, they will issue a 6% bond because this 7% bond they have issued last year, 2 years back. So you're not getting it. So if you go and check in the market, the bond should be ideally be selling at 107.36. If you invest 107.36, you're going to get 6%. So that means either buy from the primary market or from the secondary market at a higher value, you earn the same kind of return. But suppose in the market, this bond is available at only 103. Okay. Because the value has not changed. Suppose somebody is ready to sell at 103. In that case, what is the return you're getting? 6.51%. So the YTM will be 6.51. So now tell me, what will you? Will you go to the primary market and buy from the company or go to the secondary market and buy 103?
Secondary market.
Yeah, because in the secondary market, the price has not gone down to the extent it should have. So in the stock exchange, when you go, it is available at 103. Actually, it should have been available at 107. The person who is selling should have sold it at a higher price. But, he was desperate. He wanted to sell and he offered 103. So that means the YTM which you are getting is 6.51. That means if you buy the bond at 103 and keep getting 7 rupees and 107 at the end, so the return to you will be 6.51%. So YTM is nothing but yield to maturity if you hold the bond till maturity. Okay. Now, if you bought the bond at 103, then the YTM will be 6.51. Okay. So now let's go back to the, screener. So there is a YTM here. Okay. Now you understand what is the YTM? Now, if you just look at, any bond like HDFC duration, long, this thing. Okay. And just see, where they have put the money and, what is the plan. Okay. So so this is a regular and a growth. So where you should be putting money, regular or growth? Ananya? पैसा कहाँ लगाना चाहिए आपको? डायरेक्ट प्लान में Yeah, buy a fund, from a from a broker. Let me just see who have all joined first. I think many students should have joined. So अभी कितने आ गए? 8 ही आए हैं बस. Okay. So Shrishti है, Ranjana है, Raghav है. Raghav, are you there? Ishani is there. Okay. Fine. Diwali effect is there. Okay. Fine. So let's go back. Let's go back and see where we were. Yeah. So this is, HDFC low duration fund. Now, so, there are a couple of funds, regular and direct. Okay. So if you go direct, then, what is the expense ratio of this fund? Ranjana, Mahalakshmi, Ishani, Madhav? 0.45. It means that, this fund is charging 0.45% annually from, whatever return they're getting from this fund. So that money will go into the pockets of the broker, not the broker, but it's going to the fund house. Now, if you have bought this fund directly from the broker, not directly, but from the broker, then what happens to the expense ratio? It will go up or go down before it pops up? So has it gone up or gone down? The expense ratio, Malakshmi? Who answered?
Gone up.
So somebody answered, 0.45. Who was she? Ranjana or Mahalakshmi?
Yeah, yeah,
It has
sir.
gone
It
up.
has
Yeah,
gone
it
up.
has gone up. So expense ratio has gone up to 1.04 if I've chosen a regular. But when I've chosen a direct, it was just 0.45. So where the money has gone, why the expense ratio has gone up? Can anybody explain? Anyone?
So it's because there are intermediaries involved through which we
Yeah.
go in
So
regular
that
plan.
means, you have actually chosen to invest through a broker. So that difference between 0.45 and 1.04 has been paid to him. So would you like to buy direct or would you like to buy regular? Yeah,
Direct
direct
because
would be
it's
always
cheaper.
better. Regular will make sense only when, yes, you are getting some kind of a additional service from the broker. Because if he's reviewing your portfolio and telling you, which fund you should buy, low duration, high duration, medium duration, liquid, and he's giving you a lot of insights about these funds. And, he's able to generate some kind of a higher return because, he'll keep guiding you, which place to invest. But normally 99% of the brokers, they don't even come back to you. Okay. And unless you have a broker who is going to help you out to make money, you should be putting your money in a direct, otherwise regular. Now, I invest through regular. I'm ready to pay that 0.5% more because my advisor tells me, every no, even if you have a knowledge but don't have time, then it's always better to take a advice on a regular basis. Okay. So now let's further explain. Now, look at this. So this scheme is offering around, this was what? This was a HDFC low duration fund. Okay. Now, this scheme is giving around a return of about 5.68%. Okay. Okay. And the category average is 7.5%. Okay. So, this is not the best of the fund. So let's go to the best of the fund. Okay. And then go to a fund which is giving the better returns. Okay. And then see that. Okay. So I sort it on a 1 year basis and pick up, instead of picking up an outlier, I pick up a Kotak low duration fund. Okay. So Kotak low duration fund is having an expense ratio of 0.42, slightly less than that fund, earlier fund. And then, this fund is giving 8.17% return. Whereas what is the category average? 7.99. So this fund is actually a high performer. That means it is giving around, more return when you compare with, all the other funds in the same category. So it's a better fund. Okay, fine. So if you are to invest, then you must invest in this fund. Okay. Or maybe but there was one more which was outlier. We'll just go and see what that fund, how it is giving higher return. Then, this is a kind of a chart. Okay. So since inception, it is given about 8%. 1 year, it has given 8.17, up to 2 years. So you see that the interest rates, the 5-year record is not so good. If you held this bond for 5 years, you have got only 6.5% return. Okay. So how come the return is going up? It has gone up from, 6.48 to 8. So what would it mean? Why this fund has started giving you higher return in the recent year, in the first year, second year, third year? It is going up gradually. So what would be the cause of the higher return? Srishti? And what was the cause of a very low return if you hold this bond till 5? If you have bought 5 years back, your return is only 6.5%. But if you bought the bond in the last 1 year, you got 8.17. What would be the possible cause? Now, the possible cause is that the interest rates have come down. Okay, fine. So, which is actually reflecting into these funds. So, they are actually sensitive to interest rates, but not that much as compared to a long duration. So, for that, let's just see a graph. Okay, so this is the graph of the bond market, a 10-year bond in India. We always take a 10-year bond because that becomes a benchmark bond. Okay, look at at what price it is trading in the market. Okay, so currently this bond is giving 6.5% return, which is the YTM return. So this is telling you the trajectory of the interest rate. So rather, I'll just take you to the to the site. Okay, straight away.